The information in this recording is general in nature and should not be considered personal advice. Please consult a professional and qualified financial advisor to discuss how this information may apply to your personal circumstances. Thanks for listening. What if the biggest financial mistake Australians make over the next 5 years isn't choosing the wrong investment, but assuming inflation is already behind us? Hi, everyone. I'm Dane Pymble, Director of Life First Advice, and welcome to episode 3 of Life First Insights. If you've been following the series so far, you'll know that the purpose isn't to predict the future or to react to the latest headline. It's to step back from the day-to-day noise, look at the bigger picture, and hopefully provide some context that helps people make better financial decisions. Today's topic is one I've found myself coming back to repeatedly over the past few months. Has inflation really been defeated? Or are we simply in the quiet period between waves? Now, before we go any further, I want to be very clear about something. This isn't a prediction. I'm not claiming to know where inflation goes next. Nobody really does. Our responsibility as advisors isn't to predict the future with certainty. It's to study history, understand the evidence in front of us, and help families build financial plans that remain resilient across a range of possible outcomes. A lot of today's discussion draws on research I've followed for many years from property share market economics, particularly the work of Philip J. Anderson and Akhil Patel. Phil's book, The Secret Life of Real Estate and Banking, Akhil's book, The Secret Wealth Advantage, together with PSE's ongoing research, have all influenced how I think about long-term economic cycles. Not because I believe they're a crystal ball, but because I think they help us ask better questions. Over the past 2 decades, I've developed a passion for studying macroeconomics, market cycles, and portfolio management, because I believe better financial decisions begin with understanding the environment we're operating in, not simply reacting to the latest headlines. Joining me a little later in today's episode is Rory Sercombe, founder of Own Money. Rory works with borrowers every day, helping them navigate lending decisions in a changing interest rate environment. Once we've explored the broader economic picture, we'll shift gears and discuss some of the practical questions many Australian households are facing right now. Things like fixed versus variable rates, split loans, offset accounts, refinancing, and how to think about borrowing decisions when the future is uncertain. Because understanding the broader economic environment is important. But ultimately, it's the decisions we make around our finances that have the biggest impact on our future. So with that in mind, let's start with what I think is the real question. When most people hear the words inflation, interest rates, or property, they naturally think of them as separate topics. Inflation belongs in the economics section. Interest rates belong to the Reserve Bank. Property belongs to the real estate pages. But from the perspective of an Australian household, they're all part of the same conversation. Inflation influences interest rates influence mortgage repayments affect household cash flow influences borrowing capacity, investment decisions, retirement planning, and ultimately the lifestyle choices families are able to make. So these aren't isolated issues. They're deeply connected, which brings me to what I think is one of the biggest mistakes people make. We spend enormous amounts of energy trying to predict exactly where interest rates are going next. Will there be another increase? How many rate cuts? When will they happen? They're interesting questions, but I'm not convinced they're the most useful questions. I think the better question is, what does my financial plan look like if I'm wrong? Because the biggest risk isn't necessarily that interest rates rise again. The biggest risk is building a financial plan that only works if everything unfolds exactly the way we hope. That's why resilience is more important than prediction. A resilient financial plan can adapt. A fragile one depends on getting the forecast exactly right. And that brings us to the chart that first sparked my curiosity around this whole topic. A few months ago, I came across this chart through property share market economics, and what immediately caught my attention wasn't that it appeared to suggest where inflation might go next. It was what it reminded me about what happened during the 1970s. Inflation didn't simply rise and then steadily return to normal. It fell quite sharply. Many people believed the problem had been solved. Then inflation accelerated again. Now, I want to be very careful here because this is where people often jump to conclusions. This chart's not saying that the US or Australia are destined to repeat the 70s. It isn't saying inflation must follow exactly the same path. And it's certainly not suggesting everyone should rush out tomorrow and fix their mortgage. That's not the point. The value of history isn't that it predicts the future. Its value is that it broadens our thinking about what could happen as advisors and as investors. I think history is incredibly valuable because it reminds us that markets and economies rarely move in perfectly straight lines. Sometimes they surprise us. Sometimes they behave very differently to what most people expect, rather than using history to make predictions. I prefer using it to challenge my assumptions, because if we only prepare for one outcome, we leave ourselves vulnerable if something different unfolds. So it's worth taking a minute to explain exactly what this chart is saying and just importantly, what it isn't saying. Whenever you compare today's environment with history, it's easy for people to assume you're saying history will simply repeat itself. That's not what I'm suggesting. History never repeats perfectly. Different governments, different central banks, different debt levels, different demographics, different technologies, different global events. Every cycle is unique. But while history doesn't repeat exactly, it often rhymes. That's why I find these comparisons useful. Not because they tell me what will happen, but because they encourage me to ask better questions. What if inflation proves more persistent than markets currently expect? What if interest rates stay higher for longer? Would your mortgage strategy still make sense? Would your investment portfolio still be appropriate? Would your retirement plan still be achievable? Those are the questions I think Australian households should be thinking about. And here's the important thing. Even if inflation never experiences a second wave, even if rates fall exactly as markets currently expect, asking those questions still leaves you with a stronger financial plan. Preparation's never wasted. Because financial success rarely comes from predicting the future perfectly. It comes from building a plan that can adapt as when we look at Australia's own inflation history. Let's bring the discussion a little closer to home. So that first chart raised an interesting question. I wanted to know whether we could see anything similar when we looked at Australia's own inflation history. Now, before we look at this chart, there's something important to explain. This isn't trying to prove that Australia is about to repeat the 70s. It's simply taking a similar comparison and asking, what happened last time Australia experienced a significant inflationary period, and are there any lessons worth thinking about today? The comparison uses Australia's inflation data from 1970 through to 1986, alongside the period beginning in 2018. The reason for choosing those dates isn't because they line up perfectly with the US. In fact, it's the opposite. Australia's often experienced global economic cycles slightly later than the US. Different central bank decisions, different immigration patterns, different commodity cycles, and of course, a very different housing market. So rather than forcing Australia's experience to match America's timeline, I wanted to compare Australia's own inflation experience on its own terms. Again, this isn't forecasting, it's pattern recognition. It's asking whether history might help us think differently about the future. And once you start looking at it through that lens, another question naturally follows. Why might Australia's experience be slightly different from the US in the first place? One of the reasons I find economic history so fascinating is that no countries experience exactly the same cycle. They're influenced by many of the same global forces, but they often move through them at different speeds. Australia has historically benefited from things like strong commodity demand, population growth, and more recently, a very resilient housing market. Those factors can delay or sometimes often soften the impact of global economic events. But delay doesn't necessarily mean avoided. It simply means our timing can be different. That, that's why I think it's different to look at the US and immediately assume Australia will follow 6 months later. Equally, it's probably just as dangerous to assume Australia is somehow immune. History suggests we're often influenced by the same broad forces, just on a different timetable. That's why I think it's important to keep an open mind rather than becoming anchored to one particular forecast. And while inflation has clearly come down from its peak, I don't think that's the whole story. Now let's bring things right up to today. The good news is inflation has come down significantly from where it peaked. That's exactly what central banks have been trying to achieve. The thing is inflation being back under control. At the same time, we're recording this, the latest ABS monthly figures show inflation at around 4%. Housing costs are still running considerably higher than that. Underlying inflation, the trimmed mean measure that the RBA watches closely, is also still above its target range. So yes, we're in a particular better position than we were a couple of years ago, but we're not really back to what most people would describe as normal either. And that's why I don't think it's unreasonable to remain alert. Not fearful, not pessimistic, just alert. Because financial planning isn't about assuming the best or assuming the worst. It's about recognizing where the risks might sit and making sure your plan can cope if those risks become reality. And that's actually a nice lead into another piece of research that's had a big influence on how I think about markets. One of the questions I'm often asked is, what do you actually look at when you're making investment decisions? And the answer is, there isn't one thing. There never should be. At Life First Advice, we look at valuations, inflation, interest rates, market breadth, investor sentiment, risk management, and a whole range of other indicators. One of those inputs is the 18.6-year economic cycle research from Property Share Market Economics. Again, I want to stress that word, input, not prediction, not certainty, and not a crystal ball, just one input. What I find valuable about this research is that it doesn't just look at property. It looks at the interaction between credit, the broader economy, share markets, property, and human behavior. In other words, it recognizes that markets don't exist in isolation. They're all connected. Now, does that mean a cycle will play out exactly as previous cycles have? Of course not. Every cycle is different. But if a framework encourages us to ask better questions, to consider risks that others might be overlooking, and to avoid becoming overconfident, then I think it's a valuable framework. Not because it tells us what will happen, but because it encourages us to prepare for more than one possible outcome. So if we're going to use the economic cycle research as one lens, the obvious question becomes, where are Australian families most exposed to that cycle? And for most households, the answer is property. So the economic cycle is one useful way of thinking about the broader environment. Why spend so much time talking about property? The simple answer is because for most Australian families, property is by far their largest financial asset, whether it's the family home, an investment property, or both. Property often dominates the household balance sheet. And because of that, it has an enormous influence over people's financial lives. It affects how much debt they carry, how much cash flow they have available, how much flexibility they have, and ultimately how confident they feel about the future. Property is also deeply connected to credit. When borrowing becomes easier, property prices often respond. When borrowing becomes more difficult, the pressure usually starts to build somewhere in the system. And that's why I think property provides such a useful lens through which to view the broader economy. Not because property is the only thing that matters, but because it's often where Australian families feel economic change first. Whether that's through mortgage repayments, refinancing, cash flow pressure, or changes in confidence. And that's why I think it's worth asking a question that doesn't get discussed nearly enough. Did Australia actually avoid the housing reset that many other countries experienced in the GFC? Or did we simply experience a very different cycle? If we think back to the GFC, The United States experienced one of the most significant residential property downturns in modern history. House prices fell sharply, and many borrowers found themselves in negative equity. Credit markets froze. The consequences were severe. Australia's experience was very different. Yes, there were pockets of weakness, but nationally, our housing market proved remarkably resilient. Looking back, that raises an interesting question. Did Australia genuinely avoid that part of the cycle, or did we simply delay it? Or are the structural differences in our economy, things like population growth, immigration, land supply, our banking system, significant enough that the outcome is genuinely different? I don't pretend to know the answer, but I do think it's a worthwhile question to ask. Because if we simply assume that Australia's property market will always behave differently, there's a risk we stop asking difficult questions. Equally, if we assume Australia must inevitably follow every overseas experience, we risk becoming unnecessarily pessimistic. The truth is probably somewhere in between. And as advisors, that's where I think we need to be comfortable. Holding different possibilities in our minds without becoming overly attached to any one of them. And one thing we do know, however, is that late in economic cycles, interest rates often become the pressure point. One of the recurring themes throughout history is that inflation doesn't just influence prices, it influences monetary policy. When inflation proves persistent, central banks often have little choice but to keep interest rates higher for longer. And that's where households begin to feel the pressure, not because rates necessarily become extraordinarily high, but because financial decisions were often made assuming they would stay much lower. Someone who borrowed comfortably at one interest rate may discover the numbers look very different a few years later. Now, this isn't a prediction that rates have to rise again. It's simply recognizing that if inflation proves more stubborn than expected, interest rates may also remain higher than many people currently anticipate. That's why I think focusing purely on whether rates go up or down misses the bigger issue. The bigger question is, how resilient is your financial position if rates don't fall as quickly as everyone hopes? Because if your plan still works, you're in a very strong position, regardless of what the RBA decides next. And that naturally leads to what I think is probably the single most important question for Australian households. Whenever I speak to clients about interest rates, the conversation usually begins with the same question. Where do you think rates will be next year? It's a perfectly understandable question, but I don't think it's the question that creates the best financial decisions. Instead, I encourage people to ask something slightly different. What does my financial plan look like if rates stay higher for longer? Or perhaps, what happens if rates fall, but something else creates pressure instead? Maybe income changes, maybe employment changes, maybe property values soften, maybe inflation proves stickier than expected. Good financial planning isn't about building a strategy for one future, it's about building a strategy that's capable of adapting to several different futures. And I think that's where financial advice is often misunderstood. People assume we're trying to predict what happens next. In reality, we're trying to help clients build resilience before life forces them to react. Because once you're making decisions under pressure, your options are usually much narrower than they were 6 or 12 months earlier. Planning works best when it's done before it's urgently needed. So I spent the first part of today's episode looking at the broader economic picture. We've discussed inflation, the story. The more important question is, what does it actually mean for Australian households making financial decisions today? That's why I'm pleased to be joined by Rory Sercombe, founder of Own Money. Rory works with borrowers every day, helping them navigate lending decisions in an environment that's been anything but straightforward over the past few years. Rory, thanks for joining me.
Thanks so much, Dane. Thanks for having me, mate. That was fascinating to listen to.
Thank you. So let's start with what's happening on the ground. I've spent the last 15 minutes talking about inflation and economic cycles, but when people sit down with you, what are they actually worried about today?
Sure, mate. Look, I think that people are, and this hasn't changed in all the years I've been doing this, people are really fascinated by what is going to happen with property prices and interest rates. You know, there's just two things we get asked about a lot, and how they should best prepare for those. And I think that, coming off what you were saying, thinking about those questions differently is so important. Um, my clients have very, very little control about what the RBA is going to do and what property prices do, but they do have control over how they prepare for different outcomes. And I think that's where you working with your clients is so important to prepare them for those multiple outcomes. So we do get asked a lot about where we think interest rates are going to go, and I've got that. I've answered that question incorrectly enough to stop answering it, because it's a really tough question to answer. But we like to help our clients be as prepared as possible. But I suppose just give them the what we think are some ways to prepare and some ways to think about these things in a similar way, but more, I suppose, a different way. And as you said, the sort of practical side of those questions around fixed rates, particularly.
It's a good segue for my next question. It's a question I hear all the time from clients, and that's, should I fix my mortgage or should I stay variable? My instinct's always been that there's rarely one right answer for everybody, regardless of even if we could perfectly predict interest rates.
Sure.
So how do you approach that conversation with clients?
Sure. I think the starting point for me is usually around, let's look at history and let's look at if someone was to fix the rate over the last sort of 30 years, what have they paid more or less to the bank if they fix versus variable? And research tells us that they usually would be better variable, but that's not always the case. But if you're just picking an arbitrary point in time, usually it's not right to fix if you're looking at the pure maths of it. And that's because banks are usually ahead of the game. They pay a lot of really smart people a lot of money to try to predict that and to price accordingly to maximize the profits for the bank, which means that the opposite side of that is our clients are going to pay more if they fix. So that is not taking into consideration what you've just gone through, though, and trying to use some history and some predictive modelling to try to get that answer right. So I'm just saying, if you don't have that at your disposal, then generally it's better to keep variable. There has been some absolute times that doesn't apply. COVID was that time that they were artificially low, and I think people see those sort of 1 point whatever percent rates and whatever and think that was normal. It wasn't normal. It was artificial in that the RBA was pumping money into the economy to do that. So if we put COVID aside, especially generally, it's not the right time to fix historically. Like, again, not laying your data over. It was the first time I ever fixed a rate was during COVID, because I knew that was happening. So we sort of go through that. But more importantly, what we go through is you fix for your own reasons, not to win a bet with the banks. Again, generally, we think you're probably going to lose that bet. So if you take that out, if you are stressed about money and if you're stressed about where interest rates are going, and you do it for your own reasons, that's a perfect time, we think, to fix, because you're doing it according to your own plan, not trying to do it because of external forces. So they're kind of the things that we go through with our clients, along with things like being able to split your loan and being able to do some fixed, some variable if you're not so sure, and you can sort of hedge your bets. And we have those more practical conversations rather than saying this is where we think interest rates are going.
Yeah, brilliant. And the other thing that I encourage clients to think about is flexibility in their loan structures. So we spend a lot of time talking about investment returns, but having cash available can sometimes be just as valuable. And so how important do you see offset accounts and maintaining a cash buffer in today's environment?
It's hugely important. I mean, it always is. I think having a cash buffer, having an emergency fund, having whatever, if you want to put it, is so important. The research, and we try to use research not just from our sample size, but more broadly, and it shows time and time again. A couple of things. One is that people who have an emergency fund, cash buffers, do better. It shows that people who have buckets for their money are better off, and that's having offset accounts.
So you're talking about multiple offset accounts there, aren't
Yeah,
you?
absolutely. So, starting off with an offset account, which is a really effective way to both save money on your home loan, but also save up some money and have that buffer. Multiple offset accounts does it even better, where you can actually break up your money and have different buckets going. And then taking it one step further, slightly off topic, but this is research tells us having automated your money flowing through those accounts, being automated rather than you physically getting in there and doing them every week or month or whatever, is better. So we try to use science to help us inform our clients about what actually works out there and is proven to work, not just with our clients, but more broadly. So we want them to be prepared, and that we want them to work with someone like yourself, a financial planner, to actually help that along, but just executing some of these practical ways to get them in front and to get them less stressed about their money, we find is probably is definitely really, really important for most people.
Outstanding. Now to question 4 of 5. So have you had to pick one or two mistakes that you're seeing borrowers make at the moment, or maybe some big ones that, if you look back earlier in your career, what would they commonly be?
Doing the maths, doing it, just testing your cash flow, just stress testing things, is an issue that we have seen historically, and we. And it's particularly so with investors, particularly so with people who want to buy investment properties. We've seen that people just look at, things like, oh yeah, this is the interest rate now, this is my interest going out, this is rent coming in, and just do their maths on that, when, they're just not really testing other costs for property, and they're not testing if and when rates go up, because we know no matter where we're at, usually rates are going to go higher than where we're at and lower than where we're at. It just depends on where we are in that cycle. So just not stress testing. And that's why we get to a point where we rarely want to work with a property investor or a potential property investor without seeing a financial planner, because just being able to do that maths and really knowing that it's the right thing to do is really, really important to us. And it just saves that, buyer's remorse on a property, even a very cheap property in Australia, is not a good thing. It's not a thing you want to go through. So yeah, exactly. It's a really tough, expensive lesson. So do your maths beforehand. Absolutely. And then just a mistake that we see is people rushing, and people having going to a barbecue on a Sunday, thinking, oh yeah, I want to jump in a property, and by the next week they're sort of trying to make offers on properties, and it's rarely the right thing to do. It's just so take your time, know what you're doing, learn about the market, do the work, do a little bit of that work to make sure that when you're buying educated way, and sort of some lending options, and what's going to suit you in the future. So I think just if people can slow down, and unfortunately what we're seeing right now as we're recording this is because of some changes to government policy, people rushing to buy in super funds and things, which is just it's a recipe for disaster. And we're just seeing some of that, and I mean, again, it's an unusual time. You don't have these pressures usually, but we do find people, as soon as property markets start going north, they want to jump on then, and then it just creates an urgency which shouldn't be there when you're looking at spending hundreds of thousands of dollars.
100% agree. Any final thoughts? For example, if someone's watching this already has a mortgage, or they're thinking about buying a property over the next 12 months, what are the main things that you would encourage them to focus on?
Well, for my industry, I'd say see a mortgage broker. Of course, got to say that, Dave.
Absolutely.
But yeah, look, do that. Just sit down with a broker. There's thousands of us, and it's a really mature industry now, and about 80% of people use a broker, which is great. So sit down with a broker and take your time and ask the questions, and ask about different alternatives and different ways to structure a mortgage, be it with offset accounts versus redraw, fixed versus variable, or interest only, principal and interest. There's so many ways to cut up your mortgage, and combinations of those. Having offset on a fixed rate loan, which is not common, but you can do it. Bendigo Bank do one, for instance, but not all lenders are equal on those. Some do partial offset, not 100% offset on some. So there's a nuance that you need to sort of get your head around potentially. But unless you have those conversations, you won't know. And this comes back to what I said earlier, and that's just don't rush. You don't want to rush these things. So you want to start the conversations with your financial planner, with your mortgage broker, with your property advisor, your accountant, whoever it is, whoever's in your team, to make these decisions as good as possible. Start those conversations as early as possible.
Yeah, great. Well, Rory, thanks very much for joining us. I think one thing really stood out from that conversation, whether we're talking about inflation, interest rates, or mortgages, the common theme isn't trying to predict the future. It's making decisions that leave you in a stronger position regardless of what happens next. Now, I'd like to shift the conversation slightly, because if that's what all of this means for borrowers, what does it mean for investors? If you've watched our previous Life First Insights episodes, you'll know we spend a lot of time talking about long-term investing rather than reacting to headlines. And I think today's discussion reinforces exactly why. Markets don't move in straight lines, economic cycles don't unfold exactly as expected, forecasts change constantly. That's why I believe successful investing isn't about trying to predict every twist and turn. It's about building a portfolio that's capable of navigating different environments. Sometimes markets reward taking more risk. Sometimes they reward patience. Sometimes they reward preserving capital while waiting for better opportunities. The challenge, of course, is that we only know which environment we're in with the benefit of hindsight. That's why having a disciplined investment philosophy is so important. It removes the temptation to constantly chase whatever happens to be working today. So where does that leave us right now? People often ask me, so what are you doing differently at the moment? And the honest answer is not dramatically changing course every time a new inflation number is released. What we're doing is remaining thoughtful. We're continuing to assess the evidence, looking at valuations, looking at economic data, looking at market leadership, sentiment, and asking ourselves whether investors are being appropriately rewarded for the risks they're taking. As many of our clients know, we've positioned our portfolios a bit more defensively over recent months. That isn't because we know a downturn is coming. It isn't because we're making a bold prediction. It's because when we weigh up all the evidence available today, we believe caution is currently being rewarded more than complacency. That assessment may change if the evidence changes. Our positioning can change with it. Because our investment process should always follow the evidence, not our egos. And that brings me to the final point I'd like to leave you with. If there's one message I'd like people to take away from today's discussion, it's this. Nobody knows exactly what inflation will do next. Nobody knows exactly where interest rates will be 12 months from now. Nobody knows precisely how markets will perform over the next year, and that's okay. Good financial decisions don't require certainty, they require preparation. Whether you're managing a mortgage, building an investment portfolio, planning for retirement, or simply trying to make good financial decisions for your family, the goal isn't to predict every outcome. It's to build a plan that's capable of adapting as the future unfolds. Because when your financial plan is resilient, you don't need to fear uncertainty. You simply need to make good decisions as new information becomes available. Thanks very much for joining us for another episode of Life First Insights. If you found today's discussion helpful, we'd really appreciate you sharing it with someone who might also benefit. And if today's episode has prompted questions about your own financial situation, please feel free to get in touch. We look forward to seeing you in the next episode of Life First Insights.